Hi there, I'm Alan Gauld. I'm a Senior Investment Director in the Aberdeen Private Equity team and Lead Portfolio Manager of Aberdeen Private Equity Opportunities Trust, or APO for short. APO was launched over 2 decades ago, back in 2001, and it used to be called Standard Life Private Equity. And really it's about providing access to the private equity asset class to investors of all types and sizes. And throughout its 20 plus years, it's been focused on the European market principally. And we think Europe is attractive, it's heterogeneous, it's difficult to fly in and make deals. So it's all about accessing the best managers on the ground who are often in demand and oversubscribed. And that's what APO offers. I also think Europe's attractive in other ways, such as its strong focus on ESG and the fact that Europe is leading the way in terms of the green transition, which we think is a fantastic opportunity over the long term for private equity. APO partners with a small group of private equity managers through their funds and direct co-investment. And direct co-investment now equates to around 21% of the portfolio and growing. APO has over 650 underlying companies, well balanced by country, sector, maturity. And it also pays a quarterly dividend equating to a yield of around 3.5% at the moment. And lastly, in terms of APO, its long-term performance has been strong. It has an annualized NAV total return since inception of 11.5%, and the trust has grown its NAV in every year since 2010. The media does keep talking about dry powder, so it's worth taking a step back probably to kind of define that. So most private equity funds most private equity firms manage funds, which within that fund, they will make a portfolio of private companies, usually between sort of 6 and 30 private companies typically. Now, these private equity funds are mostly raised on a blind pool basis, which means that investors make capital commitments to the fund when there are no portfolio companies, and they trust the private equity firm to make the investments into these portfolio companies over time. And when the private equity firm makes those investments, it draws the capital from investors. So dry powder is defined as the capital raised by private equity funds that is yet to be invested into private companies. So it's somewhat a barometer for how well capitalized the industry is. And right now, dry powder in the private equity industry is at all-time record levels, with so many new investors being attracted to the asset class in recent years and existing investors who are very happy with the performance, increasing their exposure. So according to Preqin, total dry powder in private equity right now globally is around $1.2, $1.3 trillion. In Europe, it's around $300 billion. And as I say, that is a sort of a high watermark for the industry. It basically means that private equity managers have a lot of money to spend on new companies over the next few years. But I would say our personal view is that fundraising, because of the difficulties in fundraising right now, it's taking longer to raise funds. Funds are getting raised at sort of sometimes sizes that are smaller than the previous fund. We think that the dry powder is peaking right now, and we'll see that come off a little bit as the capital is drawn for new investment. Now, dry powder right now, according to Bain & Co. and their research, over 75% of the dry powder today was raised in the last 3 years. And private equity funds typically have 5 or 6 years to invest this capital. That is their investment period. And so that means there's still a bit of time for those funds to invest this dry powder, but they can't sit on their hands too long. They will need to get out and invest it in the short to medium term. So what does this record level of dry powder mean for APO and APO shareholders? Well, it does mean that competition is high right now. There's a lot of capital there. So naturally, that means that there's a lot of private equity firms competing for assets. I would say, though, that's not really different from recent years. It's been a competitive environment for a good 5 or 10 years now. And most of this capital, most of this dry powder is sitting with the large and mega cap funds. So the real fierce competition is probably more at the upper end of the private equity market, less so in the mid-market where APO focuses. So actually, whilst competition is still high in the mid-market, I'm not trying to say otherwise, what this does mean, this congregation of dry powder at the upper end means that for mid-market private equity firms, there is an obvious exit route to sell their portfolio businesses. They can sell them to trade, which is the most popular route in private equity in terms of exiting. But these large, well-capitalized private equity firms, will certainly have an interest in the successful businesses that mid-market firms own. So it's sort of a two-edged sword, a bit more competition in the mid-market, but also probably more exit optionality as well. And then the second point I'd make about the impact is probably that dry powder, as we know, private equity activity really since the Ukraine war and sort of rises in interest rates has been somewhat muted, certainly relative to recent years where activity has been really strong. There's not been as much new M&A being done as people kind of just pause and reflect on the new financial environment that we're in, that buyer expectations and seller expectations have been vastly different in recent times. And also access to debt financing has been more difficult. It's less available, it's more expensive. And I personally think that this record level of dry powder means that private equity activity can't stay quiet for that much longer. Private equity firms will need to go out there and use this capital. Dry powder is use it or lose it. Once your investment period goes, all you can do is make follow-on investments in your existing portfolio. You can't make new platform investments. So we think that'll trigger more activity in the marketplace. And what that means for APO is more cash coming back. But importantly, probably the more important thing I think here is around NAV growth. So usually when private equity sells assets, they do so at an uplift to the book valuation. And we saw in the last 10 years in our portfolio, that uplift upon exit was around 25% when compared to the unrealized valuation 2 quarters prior. So that helps drive consistent NAV growth. So as activity comes back into the private markets, driven by this high level of dry powder, we should see nice NAV growth from these uplifts upon exit, and that obviously has implications for the share price.